Hello and welcome to today's video where we talk about PMI or private mortgage insurance, what it is, how it works, and how to get it removed from your home loan. Let's get started. Before we get into the ins and outs of PMI, we have to go back a little bit and cover a term that we've covered in the past called loan to value or LTV. And if you recall, loan to value is really a representation of how much ownership or equity you have in your house. So for example, if you have a $100,000 house and you have an $80,000 mortgage on that house, then 80% of your home's value is taken up by the loan, and that remaining 20% is your equity that you have in that house. And loan to value ratios are really important when it comes to home buying, because for most traditional mortgages, if you do not have a loan to value of at least 80% in that house, they're going to consider you a risky borrower. And for risky borrowers, it is highly likely that you will have PMI tacked onto your home loan. So what is PMI? PMI, or private mortgage insurance, is actually insurance that protects against the case that you default on your home loan. And while it might seem like that's protection for you, it's actually insurance that your lender protects themselves with, and you have to pay for it. So not ideal at all. And the rate that you pay on PMI could vary based on a number of factors. It could be your credit score, it could be the stability of your income, but depending on who you ask, it might range from say 0.5% to even 1.5% of the value of that mortgage at any given time. So let's say that you have a $150,000 mortgage and a PMI rate of 1%. That would mean that $1,500 is added on as a PMI payment to your home loan, or about $125 a month. Now you could have somebody who could wrap that into the one loan that you pay each month, or you might be able to pay it as a lump sum. It all depends on who you're borrowing money from. No, PMI is not required on all mortgages, and as a matter of fact, it's really important that we clarify that you only see this on a particular type of mortgage, and there are many types. Most frequently, I see traditional loans, which are the type that would have PMI attached to them. These could also be called conventional loans. You have non-traditional loans or alternative mortgages. These are becoming more popular, loans that require a lower down payment. There's an alternative loan called a physician loan that's really popular that we'll cover in a separate video. There's VA loans for military service members, and there's FHA mortgages, which are also really popular. These are government mortgages, and they really stand alone when it comes to their relationship with PMI, because there are certain types of loans where on FHA loans, it's called mortgage insurance premiums. And you could have an FHA loan where this could fall off automatically once you reach a certain loan to value ratio, or you could have a type of FHA loan where that mortgage insurance premium is attached to it for the entirety of the loan. It all depends on the type of debt that you've acquired. We often get questions about how PMI affects your taxes. And as a reminder, we are not tax planners at this firm, but the summary that I would give you, or the most simplistic way I would describe it, is typically, if you have even the option of having PMI deducted from your taxable income, it's because you make a lower amount of adjusted gross income. The higher your income rises, the less likely you are to have that as a deduction. So what I would encourage you to do is ask a CPA or a certified tax preparer, whoever you work with, to look at your situation and figure out, based on your income, if you might qualify to have PMI as a deduction against your adjusted gross income. Because that likelihood decreases the more money you make, it's pretty clear, I hope you've seen to this point, that it's not ideal to have PMI added onto your loan. So how do you get it removed from your loan? There are a few options for you. Let's look at them. The first is you can reach 78% loan to value. So if you have paid down and increased your equity till you have 78% loan to value, they're actually required to take PMI off automatically without you even having to ask. The second part, though, is you could request removal in writing. So even though they have to take it off once you reach 78% loan to value, you only have to reach 80% to be eligible. So if you've done that, you can actually give them a written request and they'll remove it, or they should remove it depending on who you're borrowing from. You could also use a non-traditional or an alternative loan, even a VA loan like we just covered in the last section, or you could ask for an appraisal reconsideration. This would basically mean them looking and saying that the value of your house has increased so significantly since you moved in that now you do reach the 80% loan to value and should be eligible to have it removed from your loan. Another simple way of doing this, if the terms work out in your favor, would be to simply refinance that home. But again, you would only do that if you're walking into a better or at least an equal situation to the one that you are currently in with your mortgage. That's it. I hope we helped with this breakdown of what PMI is and how it works. If you like what you heard, please share it with as many people as you can. We want to help as many people as we can. And if you have a question that you want to see covered in a future video, you can do that by going to my website, www.brensonharrison.com. And under the blog section, there's a questionnaire you can fill out for topics that you want to hear about in the future. So we'll have more coming on this topic a little later. Thank you guys for joining us today, and we'll see you again next time.